Hello, hello everyone. So I hope you have liked my video number 1 on option basic part 1. So we will move ahead in this option basic course. So here we will cover the part 2. So before we move ahead uh, in the chapter 2 of this option basics, so I will just give you a brief idea on the some of the basic concepts uh, which we would be requiring in learning the options. So there are basically three types of markets. One is bullish. Bullish means where we expect the underlying instrument to move in the upward direction. One is bearish, where we expect the underlying instrument to move in the downward direction. And another is sideways, where we expect the underlying instrument to keep in a tight range, either to remain constant or to move in a range of plus minus 1 to 2%. Now, the value of an option, which is derived from the underlying instrument, that has basically two parts. One is intrinsic value and another is time value. Now, the price of an option is a summation of intrinsic value plus the time value. The intrinsic value is the value of an option which would be paid to you if you have exercised the same immediately. So like we have given an example in the part 1 of the basic options video, where we have said, like, say the Nifty futures is trading as 18,000 and you have bought a call option of 17,800. So in that case, the intrinsic value of the 17,800 call is 200. That is 18,000 minus 17,800. Now in that video, we have said the price of the call option of 17,800 strike was 300. So the intrinsic value in this case is 200 and the time value is 100. So the option price becomes 300. Now, we have learned in the first video that there are basically two types of option. One is European option and the American option. In India, we follow only European option. Now, under European option, we have two options. One is call option and the put option, which have been explained in detail in the first video. Now, under each of this call option and put option, we have three types of option types. One is called ITM, which is in the money. Another is called ATM, which is at the money. And third one is OTM, which is out of money. We will cover these aspects by way of a practical example in the next slide. So there are basically three types of option types under each of the call option and put option: ITM, ATM, and OTM. Just remember these three terms, which will help you to understand the next few slides. Now, an option which is having a positive intrinsic value is called in the money. Now, the example which we just spoke of 17,800 strike of the call option where the futures was as 18,000. So that is an in the money call option because that had a positive intrinsic value. So when does a call option is called as in the money? When the current price is greater than the strike price. So current price in this case was 18,000 and the strike price was 17,800. So now the current price is greater than the strike price. So that 17,800 strike call option is treated as a call option. Vice versa, in case of a put option, is will be treated as in the money when the current price is less than the strike price. Now, if we consider the same strike price of 17,800 and the Nifty futures is trading at 17,600, so in this case, 17,800 will be treated as in the money for the put option. Then the other two types of options is ATM at the money and OTM out of money. Now, a call or a put option will be called as a at the money when the current price is equal to the strike price. Now, if the Nifty futures is trading as 18,000, then 18,000 call option then 18,000 strike price call option and 18,000 strike put option will be called as at the money call option or put option. Now coming to the third category of option type is OTM. Now a call option will be called as out of money when current price is less than the strike price. So like say if the Nifty futures is trading as 18,000, then 18,000 call will be called as at the money, 17,800 strike price call will be called as in the money, and 18,200 strike price call will be treated as out of the money. Similarly, a put option will be treated as out of money when the current price is greater than the strike price. Now, if Nifty futures is trading as 18,000, then 18,000 strike price put option will be called as at the money. 18,200 strike price put option will be called as in the money put option, and 17,800 strike price put option will be called as out of money. Now we have all these slides we have just summarized by way of a table in the next slide. So see, we just referred to the first column in this slide. See, a Nifty futures is trading as 18,000. A Nifty spot is 17,950. Like I have explained in the first video of my option basic is that the price of a call option and a put option is always derived from the Nifty futures and not from the Nifty spot. Even though at the expiry of the current contract, the Nifty futures and Nifty spot will be equal. So in this case, in the first column, we have given 17,800 strike call, which is basically in the money for the call option. Why? Because Nifty futures, which is the underlying instrument, that price is greater than the strike price of this call. Similarly, 18,000 strike call will be called as at the money for the call option, and 18,200 will be called as out of money for the call option when the Nifty futures is trading as 18,000. Similar is the scenario for the put option. Now, if you refer to the second column, you will see now whereas 17,800 was in the money for the call option, it is out of money for the put option. Why? Because put option buyer will make money only if the Nifty futures start trading below 17,800, which is the strike price in this case. So in this case, since Nifty futures is trading as 18,000, so strike price 17,800 will be traded as out of money for the put option. Now 18,000 strike will be traded as at the money for both the call option and the put option, and 18,200 strike price, which was an out of money call option, whereas the same is in the money put option for the put buyers, because the Nifty futures is trading at a price which is less than the strike price, which is a criteria for the in the money put option. So if we break up the buying and selling of the option, what are the basic features of that? Now, when you are buying an option, you have to pay the full premium of that option and no additional margin is required. So like say if we are buying an 18,000 call option on the Nifty futures and say the price is trading at 300 rupees. Now, one lot of option of Nifty futures is 50 quantity. So 300 multiplied by 50 becomes 15,000 rupees. 15,000 rupees has to be paid by the option buyer and no additional margin is required. Whereas if a person is selling that option, he would be receiving that 15,000 rupees, 300 into 50. But he would be required to maintain a margin with the broker in order to cover the potential losses on the trade. Like as we explained, the person who is buying an option, his risk is always limited and his reward is always unlimited, which is the vice versa in case of the option seller. So that's why in this case, when a person is selling the option, he is receiving the premium upfront, but he has to maintain a margin. In case the trade goes against him, there may be chances of incurring the potential losses on that trade. So that's why he has to maintain the margin by the with the broker. The margins are always kept with the broker and are set by the exchanges, which is National Stock Exchange of India, Bombay Stock Exchange of India, called as NSE and BSE. And if there is a shortfall of penalty in case, in case there is a shortfall in the margin by the option seller's account, then the penalty will be levied by the broker as decided by the exchange. Just see, I have just taken a screenshot from the Zerodha website. Now this example I have just taken for the selling of an option. Now just see, I have just covered, like if somebody sells a 18,000 call for the expiry of 24th Feb 2022 contract on the Nifty, then just see what is the margin requirement on the table on the right hand side of the slide. There is a span margin 1,04,814. There is an exposure margin of 18,438. The premium which would be received by the option seller in this case would be 30,070. So the total margin will be 1,04,814, which is the span margin, plus the exposure margin 18,438. So total margin which is need to be kept by the option seller with the broker is 1,23,252 for selling one lot of call option of 18,000 H strike for this 24th Feb 2022 Nifty strike. Now this margin may vary. The exchanges keep on revising the margin from time to time, depending on the market scenarios and the risk management. And this amount has to be kept by the option seller. What is the difference between the span margin and exposure margin? The span margin has to be compulsorily kept in cash. So the margin is required in cash for the span margin, and the exposure margin can be kept either in the form of cash, or if somebody is having the equity shares in his demat account with that broker, that person can pledge those equity shares with the broker and get a certain adequate margin on those stocks. And this exposure margin can be maintained from that as well, and that can be maintained from the cash as well. So the option seller can keep a cash of 1,04,814 as the cash margin, and exposure margin he can meet by pledging the equity shares lying in the demat account maintained with that broker, or he can keep a cash as well in case it doesn't have any equity shares in his account. Now, if we go with the buying of an option, this screenshot also I have taken from the Zerodha website. So here also I have taken the same strike 18,000 on the call option for the same expiry 24th Feb 2022 on the Nifty. You just see the span margin, exposure margin, and total margin column is 0. So it doesn't need to maintain any margin. The only thing is that this premium which has been received by the option seller, 30,070 rupees, will be paid by the option buyer. The option buyer will have the limited risk and the unlimited reward, whereas the option seller will have limited reward with the extent of 30,070 rupees only, and he will have an unlimited risk in case the Nifty futures start going upward direction beyond 18,000. Now we have seen various talks on the options in the video 1 and this video 2 till now. Now, why there is a need of using the options? Why do people use the options way? So there can be various uses of option. One is hedging. So many people, institutions, like large institutions, mutual funds, and foreign institutional investors. I hope you people have heard about the mutual funds and FIIs words. So they try to hedge their equity portfolio by way of the options. And then there is another type of market participants in the market who use options as a just an speculative instrument, just in order to create income. And third, there is also a category where people do partial hedging by way of an option, and they also generate an income by using this structure. We will understand these three uses of the options in the next few slides for understanding the practical implications. So see, in this example, we just first refer the column A. Nifty futures is as 18,000. Nifty spot is at 17,950. I have deliberately used the same example again and again so that people can easily correlate the first video and the second video as well. from now onwards also, whenever I will make further videos on this basic, advanced, and intermediate and professional levels of options video, I will use this example only for the purpose of easy understanding. So see, Nifty futures, we have considered 18,000, Nifty spot as 17,950. We have considered strike price of 18,000 for both the call and the put option. Now the option price of the call option, we have considered 300, and option price of the put option also we have considered 300, since the strike price is same. Even though in the practical market, this price may not be same, there may be a slight variation. The call option may trade at 310, put option may trade at 290, and vice versa. But just for the purpose of understanding, I have taken the option price as same at 300 rupees for both the call and the put option. Now we refer to the column 2 and column 3, where we have specified person A and person B. Now just see, the person A's investment portfolio is 18 lakh rupees. In the bracket, I have written Nifty constituents. So basically, the Nifty 50 is basically an index. It constitutes of 50 companies whose equity shares are traded in the market. So I am assuming person A has invested 18 lakh rupees in equal proportion of all those 50 companies in the Nifty 50 index. A person B doesn't have any investment portfolio. He has no investment portfolio either in the Nifty constituents or any other segments of the market. Now, how can person A hedge his portfolio? Now, how can person A hedge his portfolio? He can basically buy the put option on the Nifty index and hedge his portfolio. Now, why would he buy the put option? So like as we understood in the previous slide, there are three types of market. One is bullish, one is bearish, and third one is sideways. Now, if person A feels that the market is going to be bearish, Nifty is going to fall. In case Nifty falls, obviously his investment portfolio would also fall. He wants to hedge his portfolio because his investment is long term. He doesn't want to alter his investment portfolio, but he wants to cover the downside risk of his investment portfolio, which will happen in case the Nifty starts falling from the current level. So he is basically hedge his portfolio by buying the put option. Similarly, person B, he doesn't have any investment portfolio, but he's just an speculator. Now he feels that the market is not going to fall. The market will either remain in a sideways, it will not move, it will move in a range of 1-2%, or it will be a bullish, it will move in the upward direction. So he has sold a put option. Now person A is basically using the option as a hedging tool, whereas he's protecting the downside movement of his portfolio by buying the put option, whereas person B is basically an speculator. He doesn't have any investment portfolio. He has just gone and sold a put option on the Nifty and received the premium and kept his reward as limited to the extent of the premium received, whereas his risk is unlimited. In case the Nifty starts moving on the downward, like say Nifty starts moving from 18,000 to 16,000. So even though he has received a premium of 300 rupees only, but his payout would be 2,000 rupees. Now, if we come to the second category, where we have said the options can be used in three ways. One is hedging, which we have covered. Second is the speculation. And third one is the partial hedging. Now, there are certain people who covers their investment portfolio by selling a call option as well. I will explain you how does a person do a hedging of a portfolio by selling a call option. So person A is having an investment portfolio of 18,000. He is selling a call option and hedging his portfolio partially only. Why I am saying partially, I will cover it in the next slide. Now, when should a person buy a put option who is having an investment portfolio, and when should a person sell a call option who is having an investment portfolio? So when he is expecting the market to be bearish, he should buy a put option to hedge his portfolio. When he is expecting the market to be in sideways, low movement or a movement in the range of 1-2%, then he should sell a call option. And when a person is bullish, he is expecting the market to go upwards. In that case, his investment portfolio will only go up. Then in that case, he should not hedge his portfolio. These are the three types of options used. Whereas a speculator can sell a put option and buy a call option, or he can sell a call option, buy a put option, depending on his views of the market, because he is just speculating. Now, when a person is hedging a portfolio, in case when he is buying a put option, he will not having any income from buying a put option. He would be selling out. He basically would be paying out the premium. So that premium is a cost. He will only start making money from buying a put option in case the Nifty starts moving in the downward direction. But that gain will be completely wiped out by the losses which he makes on the investment portfolio. Whereas if a person hedges his portfolio in the sideways market by selling a call option and the market doesn't go upward direction and it moves in the same range, then in that case, he will make an income as well because he has sold a call option, he has received the premium. Whereas the speculator will make the money both in case of selling the option and selling the call option as well in case the market doesn't move at all or it moves in the opposite direction. Now, that example, if we continue, so just see a person A, he had an investment portfolio of 18 lakh rupees. He is expecting the market to be bearish. He has hedged his portfolio by buying a put option. Now I have specified a hedging percentage as 50. Why I have specified as 50? Because Nifty futures is trading as 18,000. One lot of Nifty option is equal to 50 quantity. So 50 multiplied by 18,000 turns to 9 lakh rupees. Now he has a portfolio of 18 lakh rupees and he has bought a put option, one quantity only. So basically 9 lakh divided by 18 lakhs then turns out to 50%. So he has basically hedged his portfolio to the extent of 50% only. Now in order to hedge his portfolio, how much premium he has paid? The option price was 300. The quantity of a single option contract of a put option was 50. So 300 multiplied by 50 is equal to 15,000. The 15,000 rupees has been paid by this person to hedge his portfolio. Now, what is the hedging cost comes? The 15,000 divided by 18 lakhs, that comes to 0.83% per month. So see, hedging is a very costly tool. And even the big institutions, the mutual funds and FFIs, they also keeps on hedging their portfolio, but they also don't hedge it fully. Because obviously, if you start hedging your portfolio month on month, so obviously your hedging cost will turn out to 10% a year. That is 0.83% per month into 12, that will be close to 10%. Now, if somebody is making a 15 to 20% on the investment portfolio or maybe 12%, so after removing the hedging cost, the return which would be left on his investment portfolio would be peanuts. So that's why whether a person should hedge his portfolio in all the scenarios or only in the bearish scenarios or not, that depends on person to person. Because obviously the hedging is a very costly tool. Now, similarly for the person B, he doesn't have any investment portfolio. He has just sold a put option because whenever a person is buying a put option for hedging his portfolio, obviously there has to be a market participant who sells a put option. So without speculators, there won't be any liquid market. There won't be very easy buyers and suppliers. So he has basically sold a put option. He has received a same amount of premium of 15,000 rupees. This is the maximum reward for the put option seller, whereas his risk is unlimited in case the market starts moving in the downward direction. But say the person who has hedged portfolio. Now say for an example, if the Nifty falls by 10%, from 18,000, it falls to 16,200. So it fell by 1,800 points. Now in that case, since the person has bought a put option of 300 rupees, now that 300 rupees is now worth 1,800 rupees minimum. 18,000 minus 16,200. So he would be getting 1,800 rupees. He has paid an option a price of 300 rupees. So his profit becomes 1,800 minus 300, 1,500 into 50, which is the quantity for per lot of the option contract. So his profit becomes 1,500 into 50, that is 75,000 rupees. But that is not the profit. Because obviously, if the Nifty falls by 10%, obviously his portfolio can fall more than 10% or less than 10%. That will depend on the market. Just understanding hypothetically, say his portfolio also falls by 10%. So in that case, his portfolio value drops from 18 lakh rupees to 16 lakh 20,000 rupees. Now, in that case, he has incurred a portfolio loss of 1,80,000 rupees, even though he has not sold the portfolio. But if he decides to liquidate the portfolio as of now, he would be getting 16,20,000 rupees only as against the 18 lakh rupees of amount invested by him. So his loss of 1,80,000 rupees on the investment portfolio gets compensated to a certain extent by 75,000 rupees, the gain which he has got on the buying a put option. So basically, the person should hedge his portfolio only in case when he feels the market is bearish and he doesn't want to part away from his investment portfolio because he has invested the money in the equity shares of the various companies from the perspective of the long-term investment perspective only. Now we continue this use of options. This example continue. So in the first example, we have seen how a person hedges his portfolio by buying a put option, and there is a speculator is also there who is selling a. So one is the hedging, another is the speculator. Now the third category, which I said, which is a partial hedging plus income generating. Now, though I have written a partial hedging, this is not a completely hedging exercise, but people do these things also in the market. Now, say your investment portfolio is 18 lakh rupees and you feel that the market is not going to move upwards, either it will move small on the downward side or it will keep on remaining in the sideways. It will not move in either direction. It will move only plus minus 1%. So what he can do, he can basically sell a call option. 18,000 strike call option, which is trading at 300 rupees. Quantity is 50, so he will receive 15,000 rupees by selling a call option, which turns out to 0.83% on his portfolio. Now, if the market really doesn't move beyond 18,000 in that month itself, and his portfolio also remains, say for example, sacrosanct at 18 lakh rupees, so that entire 15,000 rupees he pockets it in his money. So that entire 15,000 rupees he basically pockets in his income, and that amount becomes his entire income. Now, in case the market starts moving in the upward direction, so obviously he will start incurring loss on this call option as well. But at the same time, he would be having the gain on his investment portfolio as well. Now, this option of partial hedging and generating an income either should not be used or it should be used only in case we feel that the market will remain sideways or will move to the on the downward direction to a certain extent only. There can be another way that in that case, we have considered an example where we have considered selling a call option of 18,000. 18,000 was basically an at the money call option because Nifty futures was trading as 18,000. He had sold an option of 18,000. In that case, if he wants to play on the safer side, he would have chosen an out of money call option. Instead of selling an 18,000 call, he would have sold an 18,500 call. Now, obviously, the premium received on 18,500 would be lesser as compared to 18,000 because 18,000 was at the money, 18,500 is out of money. So why the premium received would be lesser in case of OTM out of money? Because that person who has bought an OTM option and this person has sold an OTM option, he will start making money only if the Nifty futures start trading beyond 18,500. So it is still 500 points away from the current market. That's why the premium would be lesser. But in that case, he is protected on the upside of 500 points. Now, if Nifty doesn't move beyond 18,500 in the current expiry of the contract, the entire premium would be pocketed by the person who is having an investment portfolio. Plus, at the same point of time, his investment portfolio would also have grown to some extent because the Nifty has moved from 18,000 to 18,500. Whereas the person B in this case is the speculator. So person A, he has basically sold a call option. So obviously somebody has bought a call option. In that case, he has paid a premium of 15,000 rupees. That is the maximum risk for him. Whereas he will start making money only in case the Nifty futures start trading beyond 18,000 and at the expiry it trades at a price of 18,000 plus the premium which has been paid by him, that is 300 rupees. So this person will make money only in case the Nifty futures expires on the expiry date beyond 18,300.
So in this video, we have basically learned like what are the market types, bullish, bearish, and sideways, and like what are the types of the options in the money, at the money, out of money, and then we have also learned like what are the uses of the options. We can use it as a hedging tool, we can use it as a speculation tool, we can use it as a partial hedging plus the income generating tool as well. Obviously, this is just for the educational purpose. I am not recommending any trades on any of the indexes or any of the call and the put option. This is just an educational initiative to make people apprise of these this complex instrument, how this instrument can be used in the various ways of generating the income or hedging their own portfolio. So that's it from my side on this video. So this is the video number 2 on the option basic. I will be having another 3 videos, video number 3, 4, and 5 on the option basics. Then I will move to the intermediate sections of the options where I will have another 4, 5 videos, and then I will move to advanced category of the options. In that category also I will have 4, 5 videos, and then I will move to the professional levels of the options where again I will have 4 or 5 videos. So in totality, I will be covering close to 15 to 20 videos, which will have the entire nuances of the option from the basic till the advanced level. So I hope you people have liked my video number 1 and this video number 2 as well. In case you have liked, please subscribe my channel so that you can receive notifications on the any future videos which I would be uploading, as well as kindly like and give your comments and feedback, which I will try to cover up in the next video. Thank you.